Internal Revenue Service IRS tax news. Third quarter estimated tax payments due September 15th. IR 2020-205 September 9th, 2020, Washington. The Internal Revenue Service today reminded the self-employed, investors, retirees, and others with income not subject to withholding that third quarter estimated tax payments for 2020 are due September 15th. So we're talking about the 2020 estimated tax payments. This can be a little bit confusing because we have had some extensions of the dates here. So remember the 2019 tax return was due on April 15th, but then they extended it to July, but they did not extend the extension deadline. So if you had the July and you wanted to file an extension in July, the extension then went to October or goes to October, and the October is the normal extension deadline. And therefore, that once we get past October for the tax returns, we're kind of back on schedule. Similar kind of process happened with the estimated tax payments. They pushed out some of the due dates for the estimated tax payments, but we're basically back on the normal schedule for them. Now, note that the estimated tax payments are only going to be necessary if you're not getting basically your income as a W-2 withholding income, because typically then you will be paying taxes as you go, the money being withheld from the W-2 income. So typically the process here will be the normal kind of process we want to have, the IRS wants to have, is that as we go in 2020, the taxes should be taken from the paycheck in the year that you earned them, that being 2020. And in a perfect world, the tax return then being filed in 2021 for 2020 tax year would just be an informational return telling the IRS, hey, look, this is the liability I have. This is the taxes that I have already paid in one way or another. They should, in a perfect world, match up and have no refund or amount due at that time. Obviously, again, it's not a perfect world. The tax code is way too complicated for that actually to work perfectly. Therefore, the IRS still wants their money as you earn it through 2020. Our goal is to shoot a little bit high so that we get a little bit of a refund at the end of the year or in the following year when we file the tax return, so that we avoid shooting too low, because if we shoot too low, we could be subject to penalties and interest for the underpayment. That's the general goal. Now, normally we do that with withholdings from the W-2 income for W-2 employees. If you're not a W-2 employee, or if you're getting some other income, such as you're getting income from a business or something like that, which many more people might be doing as their primary business at this point in time, and or as a side business, then you're going to have to make estimated tax payments because no one's withholding any money from those wages. So you have to make estimated tax payments. Now remember, even if you have a Schedule C business, if it's like a side type of job and you have another job where you're making W-2 income, you could still increase the withholdings in your W-2 income to cover possibly your obligations to pay taxes for the business. But if your business gets to the point where you can't do that on the W-2 income, or if it's your only source of income, then you're going to have to basically make the withholdings. And so you'll have to basically make the quarterly tax payments. So you want to make them quarterly. Why do you do that? Not just so you get a refund at the end of the year, but so that you can avoid the penalties and interest that will accrue, that will happen. The IRS will charge you if you don't do that. So the third quarter then is going to be due here in September. Taxes are paid as income is received. There's a link to that here during the year through withholding from pay, pension, or certain government payments such as Social Security or unemployment, and or making quarterly estimated tax payments. Who should pay quarterly? Individuals, including sole proprietors, partners, and S corporation shareholders, generally making quarterly estimated tax payments. There's a link to that here. If they expect to owe $1,000 or more when their tax return is filed. So if you think you're going to owe more than $1,000, then you're typically going to need to make the estimated tax payments. Why? Because if you don't, the IRS will then charge penalties and interest typically. So taxpayers with income not subject to withholding, including interest, dividends, capital gains, alimony, and rental income, normally make estimated tax payments. So many people are going to have some of these items. You might have interest and dividends and whatnot. And again, if you're a W-2 employee and your interest and dividends are fairly low, then you typically can maybe cover that with your W-2 withholdings. Could help you to cover any of these other income sources that you will have to be paying taxes on. But if that's not the case, if these other income sources become large enough to the point where your W-2 income, the withholdings on it, can't be enough to cover them, or if they're your primary source of income, then of course you will need to be paying the estimated tax payment. Special rules apply to some groups of taxpayers, such as farmers, fishermen, casualty, and disaster victims, those who recently became disabled, recent retirees, and those who received income unevenly during the year. Publication 505, Tax Withholding and Estimated Tax, provides more information on estimated tax rules. The worksheet in Form 1040-ES, Estimated Tax for Individuals, there's a link to these items here, or Form 1120W, Estimated Tax for Corporations, has details on who must pay estimated tax. Penalty for underpayment. If a taxpayer underpaid their taxes, they may have to pay a penalty. This applies whether they paid through withholding or through estimated tax payments. A penalty may also apply for late estimated tax payments, even if someone is due a refund when they file their tax return. So in other words, if you have like a Schedule C type of income and you pay quarterly tax payments, you might think, well, if I just make all of my tax payments like now, then that would be fine. Even if you get a refund at the end of the year, you may still have been charged and be subject to penalties and interest because the IRS wanted their payments throughout the year. Now, that's been a little bit different this year because they've adjusted some of the due dates on it. But the general rule, that's going to be the general rule. They want their money quarterly throughout the year if you have to write an actual check to them. And therefore, if you make a payment at the end of the year, even if it's enough to cover the entire taxes for the year, you will probably be subject to penalties and interest for late payment because they want their money earlier than that. Now, note that if you do have a withholding, the IRS is more likely to see the withholding as something that's going to be evenly taken out of your check throughout the year, even if it's really not. So if you were to increase basically your withholdings towards the end of the year on like W-2 type of income, and you have uneven kind of withholdings throughout the year, then you're more then the IRS is more likely to assume that the withholdings there were done evenly throughout the year, because that's basically the assumptions when you have the withholdings as opposed to estimated tax payments. So if you increase the withholdings at the end of the year, you may not be subject to the penalties that you would be if you just made a large tax payment at the end of the year, which the IRS would typically consider as late. So in general, taxpayers don't have to pay a penalty if they meet any of these conditions. They owe less than $1,000 in tax with their tax return. Throughout the year, they paid the smaller of these two amounts. So this is kind of the safety rule, because remember, the goal here is to basically try to pay the exact amount of tax that you owe before you know what you owe, because you haven't actually made the tax return, and the tax return's way too complex to actually guess what it will be, even if your income is fairly stable throughout the year. So the IRS is going to say, hey, look, you got to at least hit these items, and if you do, then we don't charge the penalties and interest as you pay throughout the year, even though you don't know what the actual the tax liability will be. You got to pay at least 90% of the tax for the current year. So at least 90% of the tax for the current year, 100% of the tax shown on their tax return for the prior year. This can increase to 110% on adjusted gross income. So note that basically the rule is on your prior tax returns for 2019. If you paid 100% of your of the taxes that were owed on the tax return for 2019, the last time you knew what the actual tax was, then you will be okay. But there's kind of an exception to that rule, because this can be increased to 110% based on adjusted gross income. So if your adjusted gross income is above a certain level, then they may want 110% for that kind of safety rule. Or you pay at least 90% of the tax for the current year, and then you should be okay if you hit that 90% point. To see if they owe a penalty, taxpayers should use Form 2210. There's a link to that form here. The IRS may waive the penalty if someone underpaid because of unusual circumstances and not willful negligence. So it has to be unusual circumstances and not willful negligence. The term willful implies intention, which is kind of a hard thing for the IRS to prove, but notice that it's in the law a lot, right? So if you do something that's against the law, if you did it on purpose, then it's going to be more there. Then that's worse, right? And so We have the examples include casualty, disaster, and other unusual situations. An individual retired after reaching age 62 during a tax year when estimated tax payments applied. An individual became disabled during a tax year when estimated tax payments applied. There are special rules for underpayment for farmers and fishermen. Publication 505 has more information. So if you're a farmer or a fisherman, you really want to seek tax help from someone who works with farmers and fishermen, because there are areas in the tax code which can be substantially different for them, and you want to make sure that you're getting the best advice you can there. So the withholding estimator, the tax withholding estimator on irs.gov offers taxpayers a clear step-by-step method to have the right amount of tax withheld from wages and pensions. So the withholding estimator is a great tool. It's getting better and better, because what you need is to know what your withholdings are. Basically an estimate these days, because it used to be the taxes were a little bit easier in that you had more likely to have a one-income household, and you were more likely to have, like a standard household would be. So, but now, of course, and you were likely to have that one-income household have one job for multiple years. But that's not the case here. We got people switching jobs is way more common now. So you might have multiple jobs in one year, and of course we could have multiple incomes. We got multiple people switching multiple jobs in one household that's going to be filing on one tax return. So you can't really estimate with just a W-2 anymore. You need an actual estimator tool to pick up that amount of detail. You need a projection tool. You need basically tax software. And that this estimator tool is getting closer to being that. It's being closer to being a tax software. So you can use the estimator tool. You can put in your data, it can give you an estimate of what your taxes are, and then estimate how much you would need to withhold, and then help you to make the withholdings or the payments that would be necessary. So if your income has changed this year, which it has for many, many people, then you want to use the withholding estimator and see where it lies right now. Then you probably want to do it again at the beginning of next year. So for 2021, you get the proper withholding throughout the entire year. So it also have instructions to file a new form W-4. So the W-4 form is the form that you're going to give to your employer if you have W-2 income. Remember, if you go to the W-4 and you go to the Human Resources Department, they're not going to be any help most likely, because they can't give you any advice. So hopefully they're nice about that and tell you why, I can't give you advice because I just can't do that. But typically they're just going to say, I don't give tax advice. So that means that you have to talk to your CPA and or figure out your W-4 using the tax withholding estimator. Then go to your Human Resources Department and just tell them, here's my new W-4. Please, put that in play for me. And then it's just a logistics part with Human Resources, not an advice gathering point at that time. So the W-4 to give their employer to adjust the amount withholding on the pay. Other IRS.gov resources. The Pay, there's a link to Pay tab on the front page of IRS.gov provides complete tax payment information, how and when to pay, payment options, and more. Form 2210, underpayment and estimated tax by individuals and estimated trusts. There's a link to that here. Form 2220, underpayment and estimated tax by corporations. There's a link to that here. IRS, underpayment compensation is taxable. Have tax withheld now and avoid tax time surprise. There's a link to that here. Many people are getting, obviously, unemployment during this point in time. It is taxable. So you want to make sure that if you're getting unemployment, your whole tax situation is probably different than it was in the prior year. You probably want to use the withholding estimator tool to figure out if you owe any tax. If you owe tax, you may want to look into your unemployment and see if you want them to withhold some of that unemployment as you would for W-2 type of income, and that can help, and that could make it more normal, like a normal process. If you're used to a W-2 withholdings, you can have the withholdings taken out of your unemployment check, and that might be a way to meet your tax needs. So the fourth and final 2020 estimated tax payment is due in January 15th, 2020. So that's the last payment that will be due for the year 2021. So the last payment, last quarter, January 15th, 2021, is the last quarterly payment being due for the quarter ended for 2020.